Thank you, Deanne, and good morning, everyone. It's awesome to be here. This is the first time we've participated in an IMAP event. Today I'm talking about global factor investments. So VanEck, you'd know us as an ETF manufacturer in Australia, so an index, a passive investor, and so you may be thinking that I'm going to take like some very lazy jabs at active management, citing SPIVA reports. In reality, I'm going to do vastly more sophisticated ways of achieving the same outcome. But a little bit about us, not the 15-minute corporate spiel. VanEck, we've been in business for 70 years. We're a US headquartered global asset manager. We manage $200 billion. In the Australian market, it's $30 billion across 49 ETFs. And importantly, and how this links to what I'm talking about today, about 75% of our funds under management are to smart beta products, i.e. factor investments and the like. So we're the clear market leader in this part of the market. We've been doing this for over a decade in Australia, so our oldest funds are quickly approaching 13 years. Today, so we're going to quickly introduce what factor investments are, how they work, talk a little bit about smart beta more broadly, then a couple of case studies on emerging markets and international value, and spoiler alert, our view may just be that factor investing is the right way to go with those asset classes, and then just talk more generally about some factor opportunities. So in terms of, it's a bit sticky this, an introduction to factor investments. So what is factor investing? So factor investing is really looking for identifiable features across baskets of security. So if you're looking at stocks, what's the dynamic that actually can explain investment returns? And so factor investing has been around for a very long time. It's backed by academic research. And we deal a lot with MSCI, major index business, the most prominent globally, especially when it comes to factor indexes. And they've identified 7 factors. So it's based on academic research. And so being growth stocks, value stocks, quality, you've got the list there. But these are different features between different types of securities as well. So growth stocks, those companies that are growing their profits very, very fast. Don't worry about valuations. It's all about the sizzle of the earnings growth. Quality stocks, so things that have got profits, but very stable earnings. So not about variability of earnings. Quality company would be one that's not terribly highly leveraged, so looking at strong balance sheets as well. Value stocks, things like low price to earnings, low price to book. Those sorts of metrics are what we're looking at. And if we look at the evolution of factor investing, a lot of you may have seen versions of this chart as well, which really kind of explains the evolution of active management, but it also explains, I guess, why smart beta products are so popular today. And so if you went back to the 1960s, it's all about active returns. Active managers get compared against other active managers, and that's what's going on. During that time, there's academics working on things like the efficient market hypothesis, the CAPM, risk-adjusted returns. You have market capitalisation indices created, and that creates your market beta. And so come the 1970s, it's about splitting out returns into what's driven by the beta and then the alpha, so the excess returns. And with the strong objective of trying to outperform markets. During that time, academics got a bit disgruntled, saying, there's actually more to it. It's not the markets aren't efficient. There must be different drivers of returns. And so the common ones at that point was that then there was a view that value stocks outperform growth. And surprise, surprise, the years that followed, a lot of value managers in particular came to market as well. And so you had the market beta, you had what's explained by being a value style or a growth style, and then the alpha return as well. But then with time, with data, with technology, the ability to actually identify more granular aspects of what drives returns became possible. And that's really what's driven things in more recent decades as well, this big push to factor investing. And so we would say, and this is where it reflects our history as a firm, which is as an active funds manager, we think there's a lot of clever things that active fund managers do. A lot of it can be attributed to certain persistent styles or factors, and where it can be, you don't need to be paying 1% or 1.5% or performance fees for that. So, to do a bit of a deep dive, or a rather shallow one actually here, in terms of some familiar factors there, I've actually just kind of listed, so growth, value and quality as being distinct factors there. And so the kind of characteristics of a growth stock, so the punching earnings per share growth rate, the internal growth rate, sales growth, everything. So looking at that kind of, like I said before, the sizzle of prospective earnings growth down the track, and we've got some examples in there. You wouldn't find those sorts of stocks in a value focused fund. So they're going to be trading on very high PEs, whereas if you're looking at value investing, it's price to earnings, price to book, enterprise value over cash flow from operations, those sorts of value factors as well. Quality, high return on equity, stable earnings, low financial leverage as well. And what you actually find is you don't see much overlap between these factors at a stock level. So we run a Qual, VLUE, GWTH international via MSCI indexes. Take quality and value. Quality's got 300 stocks in it. Value's got 250. There's only actually 20 overlapping names. So they're very distinct. And why this is important and why you should be looking at factor investing is this isn't a new phenomenon. Broadly speaking, the most important part of this chart is to say over long periods of time, these types of factors add value in portfolios. But it's not as simple as outperforming during all market environments, because that's obviously a nonsense as well. But growth, quality and value have done very, very well over long periods of time. So now I want to talk about how you go about accessing those and why you would look to it. And so what actually influences the factor performance. And so the way we speak to this and the way we talk to advisors and to institutional investors about why to look at and how to look at factor strategies, we often use this framework of looking at the economic cycle. So if you look at the 4 distinct phases of the cycle: expansion, slowdown, contraction, recovery, and we use the PMI, US PMIs here as just a graphical representation over the last 25 or so years, and it's colour-coded as to what part of the cycle it is at any point of time. We find that really instructive in terms of looking at how different factors do during different types of economic climates. And so moving into that, and there's a lot of information on this slide, so I'll try and make it as simple as possible. The chart on the left is about quality, the chart on the right is about value. The PMI stuff, so the colourful dots, are the same on both slides. It's where we're at any particular point in time. The black line is the ratio of either, on the left, the quality index over the market beta, and on the right, the value index over the market beta. So if the black line is sloping upwards, it means on the left, quality's outperforming, sloping downwards, quality's underperforming, and same on the right-hand side there. And what you notice is there's periods where both of those are doing extremely well and periods where they're actually underperforming as well, and they tend to do that in different types of economic climates. And to kind of the short version of what's on the table below is using all that data over almost 30 years. It's kind of say, look, these factors do add value over long periods of time, but in different marketing climates. So in an expansionary economic cycle, that tends to be best for value. That's been what we've seen in the last 12 months or so, and as a result, all the value managers are out there beating the drum saying, look at us, we outperformed. Well, that's a factor rotation at play. Quality tends to do extremely well in a relative sense in those periods of slowdown and contraction. It's seem to be more of a defensive, through the cycle core kind of component for a portfolio. So that's a bit of background. I just want to talk about this in terms of use one of the most overused words ever, disruption, and smart beta is the great disruptor as well. And so this is rather alarmist headline we've got here, benchmark huggers face extinction. And to be fair, this is probably a very old story, which is for the last 15 years, there has been an enormous transition of wealth from active management to passive. And a lot of that has been because certain active funds broadly track the index and have charged clients 100 basis points for that distinct pleasure. And that business model is effectively over. And so that money has moved to kind of your market beta kind of exposures, your market cap indexes. But we think there's another evolution that's at play at the moment. And this is a report by academics Khan and Lemon. It was in the Financial Analysts Journal. And what they did was they took dozens and dozens of active global equity managers. And instead of just lazily going, do they outperform or underperform, they wanted to see what drove the performance. So looked at the attribution of the returns. Is it being driven by growth? Is it being explained by quality or value? And what they found, and so effectively on the left-hand side, the R square, that's the further to the right you go, the greater it is that an individual manager had all their returns explained by actual smart beta factors. And if you look at it, around half of those active funds had a fair bit of their return explained not through idiosyncratic risk or just stock selections slash skill, but actually through factors. And on the right, the little dark blue triangles are the fees versus that explanatory variable, like how much is explained away. And they've done a line of, not a best fit, but the downward sloping linear line there of light blue is the predictive fee. And they've basically gone, those ones that are charging the high fees when their returns are explained by factors, they're getting squeezed, both at a fee level and they're going to lose business. We actually did the same study over the Aussie equity market and the results were even more pronounced. So now, this is an answer to Toby's question from the last session. It was a great segue into mine, talking about the SPIVA and emerging market equities. I'm about to do a case study on emerging markets. But before I do, I just want to kind of put this chart up here, which shows the active EM, the average active manager, how they've performed in each of the last 14 calendar years. And now, emerging markets, that would be deemed one of those sectors that's deeply inefficient. If you would ask, if I had done a show of hands to say, who thinks small caps should be actively managed, everyone would put their hands up, same with emerging markets. The facts don't support that. 10 out of the last 14 years, the average active emerging market manager has underperformed. The dispersion between them as well has been enormous year to year as well. Now, that's just kind of a little bit of background. Now, I want to get into emerging markets more broadly. And Jonathan, the previous speaker, did a fair bit of this for me. So I'm just going to step through a few slides here, setting up the framework as to why emerging markets does and has looked very interesting. And so the first is, compared to the developed world, earnings per share growth, forecast earnings per share growth is much stronger. GDP growth is stronger, inflation is lower. So that's slide one. Valuations look compelling as well, both in absolute terms, but certainly in a relative sense as well. And so the chart on the left is the price-to-earnings ratio. The chart on the right is the price-to-book. The two bottom lines are different emerging market indexes. It's not really important which one's which, but the point is they sit much, much lower and at a huge gap to the MSCI world as well. So great from a valuation perspective. Emerging markets got inflation under control a lot earlier, went hard in terms of rate rises, inflation is lower, and so there's actually more policy scope for lowering rates, which is also supportive. And then a final bit, which is the relationship between the US dollar and emerging market equity returns as well. We've had a weakening dollar environment, which we think is a structural theme, strengthened a little bit of late, but a weakening US dollar, a falling US dollar is good for emerging market equities. What what do those 4 slides that I've skimmed through have to do with factor investing? Effectively nothing. Why did I say it? Well, in the last year, every investment strategist, think of every conference you've gone to, how many people have spoken about the case for emerging markets. Every fund manager, investment strategist, asset allocator, asset consultant has been talking about emerging market equities and the opportunity there. And that's a real kind of, these are the cliff notes. Better earnings growth, better valuations, lower inflation, falling US dollar. A huge amount of money has moved to emerging market funds for all these right reasons. Last year, emerging market equities at an index level did 25%. And we're hearing all the sorts of stories about clients that have made those allocations to an asset class that is harder to get clients to actually allocate to because of the inherent risks. And EM has ripped, and they've done low single-digit returns or even negative returns. And so that's the backdrop that we think is just a terrible outcome for clients, and they've actually made the right decision in the first place. So I want to talk about how to get exposure and how we think about this. And so we rerun a multi-factor emerging market equity fund. And so I'll explain a bit more about what that means in a moment. But why would we look to combine factors in emerging markets versus the developed world? And so the reason in a nutshell is on the left, look at how tightly matching each other those lines are for the developed world. So the economic cycles across developed market economies are pretty much in sync. Whereas if you look on the right-hand side, it's way more dispersed. What's happening in India is different to what's happening in China, which is different to what's happening in South America. You've got this huge dispersion there. A little bit about the ETF. We track the MSCI Emerging Markets Multi-Factor Index. It's a big fund and it's 8 years old, and I'll come back to that in a moment. And then when you look at country dispersion as well, country returns in emerging markets versus the developed world, those individual countries have huge return differential outcomes on an annual basis. So you can see the much wider apart columns for the left versus the right, which is emerging markets versus developed markets. And unlike the developed world, so because everything is so different and because the economic cycles are so out of whack with each other, emerging market factors don't behave as you'd expect. So I'm going to show you a slide in a moment that shows, just like developed markets, the individual factors add value over long periods of time. But what we mean by they don't behave as they're expected is the purple and blue dots there of either outperformance or underperformance are for value and for growth, for value and for quality. And they should be doing different things at different times. And the point of this chart isn't to go into detail, but to say those dots appear above the line at the same time and below the line at the same time on a regular basis. And that shouldn't happen. If you looked at the developed world, typically when value is outperforming, quality is underperforming, and vice versa. And this comes down to those differing economic cycles. So as for what we mean by multi-factor, we look at value stocks, so cheap stocks, so low price earnings, forward earnings, price to book, those measures. Momentum's been a factor that has explained outperformance, so giving preference to stocks that have actually shown momentum characteristics. Quality, a lot of people will be familiar with our qual ETF, high return on equity, stable earnings, low financial leverage. Well, they're the same screens here as well. And size, which is a blunt, recognising that small cap premium, so preference for smaller securities. And so they're the 4 factors that the index gets screened on. And so the bottom line here in orange is the MSCI Emerging Markets. The dark line that's hidden at the top is the multi-factor, and the single factors are in between. And so the point of this is, over long periods of time, each of those single factors have done very well. Blended together, it's the best outcome, and also a very a more stable outcome as well. I'm in business development. I love this slide. We've got 2.35% outperformance over the MSCI world over We're a few days shy of being 8 years old for the fund, so it's a long track record now, but very persistent in the value add. I like this slide even more, which is, if you look out over all periods, it's top decile, and here is a passive, so an index-based emerging market equity strategy that is the number one emerging market fund out of the peer group over 7 years, and 3 years for that matter. And it's charging 0.69, which is roughly about half of what most emerging market equity funds charge. So I think I've made the kind of point on emerging markets as well. So by the way, for what it's worth, we love the asset class. We hear this all the time. Oh, we like it too, but we think it should be active. We think there's inefficiencies in there. And this is the kind of best way via a multi-factor approach, which is tried and tested now in terms of the value add, the lower volatility, the less drawdowns than the broad market index at a very low price point. Now, the other case study I wanted to go into was international value, because this has been, so value as a style has worked extremely well in the last year, but it hasn't worked very well for a long period of time at all. So it's for pretty much since the GFC, it's been a period where growth has taken over. And things are cyclical. We don't think value investing is dead, but it's shown some signs of life, that's for sure, in the last year or so. So the orange line is the value index. Importantly, so the purple being the growth, last year was a big story. It was just the AI trade. I don't have it on this. I don't have it on this chart. But if you went from the bottom of the market liberation day through to around September, October, when the whole rhetoric was AI, Magnificent Seven, growth stocks, Nasdaq. The value ETF of ours had actually outperformed the Nasdaq during that period, and what we've seen since then is the growth names roll over big time and come off hard, and values continue doing really, really well. And so, if we look at the setup as to why we think the rotation could be prolonged, look at the indicators on the left for that the period from 02 to 07. So, rising inflation and rising yield environment. A lot of the setup that we're seeing right now feels very much like it did in those years between the tech wreck and the GFC from a inflation and rates perspective. And during that period, we saw an enormous outperformance from value stocks. If you went back, for those of you old enough to remember in this room, the growthy kind of names and tech-focused funds, they weren't the popular ones during that period. The biggest global equity managers were value funds as well. And this is a trade that people have largely missed in the last year, but we actually think it could be very much prolonged, because when we look at things, I think long end yields are elevated and we think they'll stay there as well. If we look at those environments as well, so we've got a period kind of through to like 2000 through to 2011, higher rate regime. That's high rate 1, and then high rate 2 is the last few years, and then the period in between was that kind of structural low rate story. We saw obviously value being a long way behind during the low rate regime, but certainly did a heck of a lot better during those higher rate environments as well. Mindful of time, a lot of the value names appear in Europe and Japan. I won't go through this in a lot of detail. Well, I won't go through it in any detail, actually. That valuation differential as well, if you compare just the value index to the MSCI World, it's the differential is as wide as it's been for a very long period of time as well. So, in short, this value rotation could very much be a prolonged sort of thing. And again, so like I said at the start, we don't think that means you go to an active value manager and take key person risk, business risk where they're deviating too far from the benchmark as well. But buying a factor index product, such as VLUE, which is our global value fund, 250 value stocks that are screened by price to book, price to forward earnings, and enterprise value to cash flow from operations, to narrow the 12 or 1,300 stocks in the MSCI world down to those best valuation stocks as well. This fund it's 5 years old now. We'll be able to print a month-end figure for it in the next at the end of this month, actually. So, this summarises the process behind it. I've just explained it as well. And the important thing to note here, so this 5 year we can't print because it's a few days shy of it, but since VLU inception, so 4 years and about 350 days or so, it's been top decile over that time, which not many value funds have been. A lot of it has been because of its amazing run in the value kind of climate. And the way I like to look at this is to compare it to a value peer group, because there's a lot of active value funds out there beating the drum loudly at the moment, saying, look how well we did last year. And so we've got by 1, 3 and almost 5 years, the numbers at the top, and then the calendar years as well. And we've compared VLUE against a range of very well-known value managers. And so a couple of things I'd say on this is, over 1 year, they've all outperformed. The question, if I was allocated to fund manager C and D, is the question I'd be asking is like, value absolutely ripped last year. Why are we only 3% ahead? You've been behind for so long. How is this an acceptable outcome for a period where value investing did extremely well? So that'd be my kind of first point. And the second one is you get what's written on the tin with buying a factor strategy. So in 2025, I think we outperformed by something like 20%. 2022, that was actually a period as well where there was a value rotation as well. And again, in that was 9.64% outperformance in 2022. So the point being, when it comes to deploying factor strategies, it's about, these are building blocks for your portfolios, much the same way as you'd be targeting growth managers or value managers or quality managers as well. These are just building blocks for your portfolios. And if you have a view that is, we think value is the place to be, then we think you should express that view through a factor index strategy, because you will get what's written on the tin. And that's what I think. So we're not out here saying that value as a style will outperform over every market environment. We're far from it as well, and very transparent up front to kind of go, there's certain economic regimes where these types of companies do well and then less well. But if you're wanting to position for value, then there's tools such as VLUE and the hedged version, HVLU. If you're wanting to position for quality, so Qual is an $8 billion product, so a lot of you probably actually use it or are familiar with it. Quality small caps, QSML, and the hedged version as well, or growth. These are all tools that are at your disposal. So with that, I think I've got a few minutes left here, so I hope that was worthwhile. I've got my colleagues Matt, Cleo, Campbell in the room. We've got a booth. We're happy to do the deep dive on any of these types of strategies at any point. So thank you very much.
And opportunities for questions. So I have a question about the emerging markets multi-factor. What is it that, to what extent is there any active selection amongst and between those factors within that fund?
So technically, EMKT physically replicates the MSCI Emerging Market Multi-Factor Index. So it is an index, and all we do is replicate that index. However, the MSCI Emerging Markets Index is about 4,000 securities. After deploying those factors, so the multiple screens on value, on momentum, on quality, and on size, it filters it down to about 200 names. So it's heavily modified compared to the broad index. So that's where I guess this is the grey area where factor investing or smart beta products between active and passive, because it's not active. We don't have portfolio managers at the helm saying, look, we met with this company and love it, or we think we should sell that, or whatever. We're replicating an index, but the multi-factor approach has characteristics very much akin to what an active strategy should be doing. Especially this part, actually, by the way. It's a convenient one to pull up, the 2.5% outperformance over 8 years, but I'm struggling to get to that slide. But yes, no active component to this index here, the MSCI Emerging Markets Multi-Factor Select Index, but it's very, very different to the broad market beta.
And so I presume that as companies' characteristics change, MSCI's filter process says in or out.
Yes. So on all of these, so they're rules-based and systematic, but typically will be being rebalanced. Most smart beta products, whether it's a quarterly or every 6 months, MSCI rebalance every 6 months. So they that's May and November. They run all the filters through it and work out what stocks come and go, and then we trade the portfolio to reflect the new index.